Let's talk about a beaten down name in the EV trade. George Tsilis checking in on ChargePoint while it's still around. George, trading like $1.70. How long is this thing going to be a publicly traded stock?
I think. Well, look. Obviously, it's in a catastrophic decline. If you look at the price action, I think going back a few years, it's down like 95%. But I think it's going to be around for a little bit longer. Obviously, it's still losing money as a company, but it doesn't have a big debt issue. If it had a debt issue or a balance sheet issue, we would be more in line with being a sub $1 stock right now. But let's look at the report on this name, which again, if you look at some of the headlines, just going back not too long ago, this is a company that installs, of course, the charging stations, not the supercharging networks that you see Tesla being involved in with their standards now, but this is a company that competes quite aggressively in the very highly competitive space for all the charging stations that go into things like, multifamily units and hospitality and restaurants and things of that capacity. So they're more localized, but they also face a lot of competition. I think that's why the whole group, which includes EVgo or EVGO and Blink, they're all down significantly over the last few years. So if you look at the report, obviously they did publish an adjusted loss. They were expecting on a GAAP basis a loss of 18 cents. They bested that by a penny, so they lost 17 cents. Sales were down 17%. 130 was the print last year million. In this quarter around, it was 107 million. So irrespective of the beat, which was about a million and change, the stock really isn't doing much, if not to the downside in the after hours, because the challenge still is the negative earnings yield. If you just do the math, it's very simple. Looking at the price of the stock, roughly at $7.70, just looking at 2025's earnings, they're expected to lose 37 cents. So what I have to do is make a simple division of the losses into the price, and so you have a negative 20+% earnings yield that you have to contend with sales that are down. Looking at the print, they published sales down 17%. They also guided lower at the midpoint. It looks like 113 million versus the 121 million estimate for the next quarter. So it's tough. You've got sales that are in decline or decelerating sales growth, and at the same time, you're not profitable. And that's why you have a stock that's sort of a melting ice cube if you look at it over the last 3 years, because it's just losing money. And so it has a negative earnings yield. And so the stock price will move from the top left to the bottom right on the chart.
Do they have any IP? Do they have any real estate? Do they have anything they could sell to like someone like Tesla that's just building everything out and totally absorbing the infrastructure?
Well, I mean, look, they did denote in a headline not too long ago that they got a contract with Airbnb. I think that's meaningful as the premier installation of charging stations for hosts and guests on their platform. But I'm just looking at it from a financial standpoint. One, I think they've got operational challenges. Two, I think the competitive landscape in this space is quite aggressive. And I don't think the technology is really unique. And that's the other thing you have to contend with. These are not, very complex, installations. You could actually have somebody install one in your home that's completely separate from ChargePoint. I'm not saying the company's bad or the technology bad. I'm just saying that they don't necessarily have IP that's a standout compared to, the other competition, or even somebody who wants to install it using an electrician in their home.
All right. Good stuff. Thanks, George, for checking in. Going down to the dollar stocks for us to keep us honest here. All right, coming up.